Moving on now, the International Monetary Fund has warned that sub-Saharan African nations are at risk of debt distress. The financial body attributes the risk to heavy borrowing and gaping deficits despite overall economic growth. Now, the assessment comes as African countries continue to tap international debt markets and issue record levels of debt in foreign currencies, spurred on by insatiable investor demand for yields. According to the IMF's findings, African governments issued a record $7.5 billion in sovereign bonds just last year, which is 10 times more than in 2016, and they plan to issue over $11 billion in additional debt in the first half of 2018 alone. Now, one of the affected countries is Nigeria, and let's discuss this further with economist Gabriel Idahosa. He joins us in Lagos now. Very welcome to the show, sir. Now, on one hand, we have the IMF concerned over Nigeria's ability to service its external debt as a result of its low revenue base and dependence on oil. But on the other hand, the Minister of Finance, Kemi Adeosun, says there is no cause for alarm. What are your thoughts on that, sir?
Here in Nigeria, the concern is not about the capacity to pay those loans. Our budget is 24% debt service, but in terms of the GDP, we are currently at just 15% debt to GDP, which is quite low in the world. If you look at countries like Saudi Arabia, they are 30%, Angola 87%. So in terms of what we are exposed as part of our GDP is quite low. So our capacity to pay is not in doubt. The concern of IMF is the part of our budget that we use to service debts. The IMF and of course the local economy watchers believe that we should spend more on capital expenditure rather than on debt service. But the capacity to pay is pretty much below what we can do in terms of our current level of debts.
Now, we just saw this week growth slowed in the first quarter of the year. We saw growth, especially in the non-oil sector, was just a paltry 0.8%. Analysts are saying consumer spending is also incredibly weak right now. Do you think this trend is a concern, especially on Nigeria's future ability to build buffers?
Yes, if we look at the movement in our foreign currency in the last 3 years, our results have gone from $20 billion to about $49 billion. In terms of the agricultural part of that, which is the most sustainable part of it, agriculture is doing between 30 to 40% of the GDP. The oil part of our GDP has gone down from over 50% to less than 25%. So most of our GDP now comes from agriculture, from services. These parts of the economy are sustainable and they are not subject to too much international fluctuations. And that is why the minister and local economy watchers believe that we can sustain the economy and we will not grow as fast as we used to be at 7%. But we are likely to continue to maintain between 2 to 3%, which is not enough for an economy like Nigeria. But we have the internal capacity to maintain that growth path. And in 2 years, we expect to have a much greater capacity when we achieve self-sufficiency in petroleum products. Once we are able to do petroleum products locally and food sufficiency, particularly in products like rice, that will save about 40–45% of our current import bill because we spend about that percentage on import of petroleum products and food. Once we take that out of our import bill, then we will have a much higher capacity to grow the economy locally without depending on oil. And that is going to manifest much more in the next 2 years because the plants, the various refinery plants being built now will come on stream, some of them later this year, most of them by the end of 2019. And once we become self-sufficient in those two key areas of food major staple foods and petroleum products,
Right.
we will see a much higher growth rate. We expect to go back to between 4 to 5%.
Now, Finance Minister Kemi Adeosun, she also mentioned the fact that the IMF's warning will not stop Nigeria from continuing to borrow from international markets and local markets as well. Some believe the right course of action is for Nigeria to focus more on tax collection. What are your thoughts on that?